Good afternoon. This is Ken at Tortoise Capital with a review of the weekend trading reports for November 30th, 2018. Market is in sideways normal conditions. So this is a market state in which we should shorten our time horizons, focus on short-term gains rather than long-term, minimize our excess exposure to risk, look for market leaders to begin to emerge to take us in the next direction, whether that's up or down. And then look to build positions on those emergent leaders as we go. We would start with short-term winners or losers, and then try to build if there's a consistent movement day over day. But because it's sideways, then we are less inclined to hold things overnight, more inclined to cash them when we have them, realizing that the market is unlikely to run away from us from these conditions. On a short-term basis, on a long-term basis, using NDX 260, the market is in the middle of neutral at 55 out of 100. On a short-term basis, using 10-day NDX, it's temporarily overbought at 95 out of 100. In the market mosaic, price with respect to the 200-day moving average is red sideways with a score of minus 0.11%, so we're just slightly below the 200. The 50-day moving average slope is red bearish at minus 0.54. That is, both of those are negative for longer-term swing positions, so don't be in a hurry to get those swing positions in. ADX is at 29, so it's a relatively strong trending market, and right now, believe it or not, the bulls are in charge. The risk index is the 30-period moving average of the VIX divided by the 10. The boundary between risk on and risk off is 1.0. The current reading is at 1.05. So we are just into risk on conditions. So the potential for long-term swings from this price level is certainly a possibility. We've already seen the harsh sell-off about 10 days ago, and there have been a couple efforts to move the market up, and so we'll actually be looking for the long side winners to emerge. Now that we have a mixed House and Senate, we can expect a stable business climate because of inactivity in Congress. That's always been good for business, so we should look to see who the emergent leaders are coming out of the gridlock. You can see the blended monthly rebalancing positions that we're holding right now. The rebalancing is on or about 1 December, so Monday we'll be taking a look at those current leaders and rotating right now into, for example, Latin America, real estate, and the Dow 30, if we're tracking ETF 13 and so on. You can see the key leaders in the other trading populations. Of interest are those defensive plays like Merck, Procter & Gamble, Pfizer, McDonald's, and Verizon. Those are all key members of the Dow, and the defensive sectors like staples and basic and healthcare, excuse me. So it wouldn't surprise me to continue to see them hold sway. In ATF2, the theoretical exposure is at 20%. So again, this is a market that has to prove itself, and we have opportunities to add to positions as we go. When you take a look at the daily histogram for the last 90 days for the risk C, you can see the big sell-off happened about 20 days ago, and then there's been some slow recovery, two efforts to rebound this market. It hasn't had complete follow-through yet, so we actually do have some room before it gets back up to the swing high. But conditions are starting to look favorable for the long side. We just don't have to be in a hurry right now. Quick look at some of the ETF BMR portfolios. This is ETF 13. You can see that the majority are in a cash position. The strong sectors are Latin America, real estate, and the Dow 30. Emerging markets is also, oddly enough, above its 4-month moving average, so it actually is on a buy signal. Although its performance is bad, it's actually been healing while the U.S. has been lagging. So You notice that the U.S. small caps are in the worst position right now, and so if we see some market strength out of the S&P and the diamonds, then this may be an opportunity to get IWM on sale, and that will certainly draw the attention of traders everywhere. ETF 32 portfolio, again, the majority are on cash positions. You can see that the key leaders, now that we've added some fidelity here, Brazil, healthcare, consumer staples, and utilities. So it's those defensive plays, as well as Brazil and Latin America are leading the way. So defensive plays are being called for here. The Dow 30, quick look here. Notice that Pfizer had a pretty amazing one-week move, and so I'd be looking for follow-through on that one. Merck, Procter, McDonald's, Verizon round out the top 5. Coke, Johnson & Johnson, and United Health. So again, the key leaders right now are all these staples in the large caps, so that's the way that I'm going to stay focused. Looking at the sector spiders, this is an expansion of the XL series. Again, mostly are on cash positions. See the defensive plays once more: healthcare, staples, utilities, real estate, insurance. So no surprises. ETF Max looks at about 500 of the most liquid ETFs from around the world, and there's a couple things that jump out at me on this one. I like the idea of natural gas and palladium having been strong and are continuing to outperform. You see Brazil, how actually strong it is, and you can see that the VXX and the other volatility instruments, although they have been performing well over longer term periods, really got smacked down the last week and a month, and that is establishing the basis for a belief in the upside swing potential. There was a rise in volatility and a sharp, harsh sell-off, one of the worst of the last 10 years. And so now these key leaders and the defensive plays are leading the way. And as volatility declines, those are still the way to look for continuation patterns. The ETF regional report. So 2 of the 10 indexes are on buy signals, and that's why the theoretical model is at 20% invested, 80% cash on an allocation basis. That's an improvement over last week, in which all of the 10 indices were below their 4-month moving average. The US at 32 is better than EFA at 27 on strength, and so the US is still outperforming the other broad global first world nations. Inside the U.S., it's the S&P, followed by mid caps, then tech, and then small caps are bringing up the rear. 2 strongest sectors, Latin America and the S&P large caps. 2 weakest sectors, European 350 and the Asia European globals. Inside the sector spiders, the 3 key leaders: staples, utilities, and healthcare. Once again, the defensive plays. The laggards are technology, financials, and energy, with industrials, financials, and discretionary in the middle positions. Looking at the broad market model, you see most of the U.S. is below average, with the exception of the S&P and the Dow. Mixed bag in the country of both Asia and Europe. Clear leader here in Brazil, clear loser in Mexico. So you can see that country level divergence. And that is a really nice way to play, since both of those are strong intraday frog candidates as well as good swing candidates, and they both have lots of volatility. So those will be high on my priority list for both intraday and swing trading signals. The ETF top 30, based on the blended monthly rebalancing and in the ETF2 portfolio here. Those that are green across the board are long-term winners, like staples and healthcare. And you can see that Brazil is yellow on quality, and that comes from the excess volatility they've been experiencing, but their outperformance has been there, both on a weekly and 10-weekly basis for strength and consistency. You can see that in the table below how we use the basic heuristics of these categories and colors for strength, consistency, quality, and then the aggregate average, and then the kinds of strategies we seek to apply in the table below. ETF liquidity simply updates the most liquid ETFs on the basis of average daily dollar volume over the last 30 days, and then you can see the relative volatility. So an ideal candidate is one that is on this list because it's liquid and then has a higher ATR percentage, so you're getting the intraday volatility as well. That's why something like the Qs and IWM are ideal intraday trading candidates. Now, shifting to the daily report from Friday for Monday, let's take a look at the market health check first. The vertical blue lines are 10, 20, 30, 40, and 50 days worth of look back. You can see the price is still well below the this declining RL 270. We treat that as the long-term fair value. It's now sloping downward. The river is sloping downward. You can see the channel has kind of been established, however, between about looks like 262 and 280. And then you can see the dragon swimming from side to side, and the 10-period RAF regression channel is now sloping upwards, and you can see the boundaries of normal for that price action based on that indicator, while the 30-period RAF regression channel is basically flat. So this is evidence of a market that is healing from the sell-off and is beginning to show short-term signs of bouncing. You can see there's been a double bottom in place here, and prices moved through the dragon and is above the Bollinger Band mean. So I will be prepared to go long on a mechanical entry 5 cents above Friday's high and building like on to fourth day momentum. So there were 3 days last week in a row where it had an opportunity to fail, but it didn't. That was enough to bring it out of the winter session and back into the spring. So with just a little bit more juice, this thing will be into the summer, and then we'll find out what kind of market it is as it tests 280. If it gets through that RAF regression channel and the dragon hump around 280, then 285 is in play, and then the swing highs back around 293 are also in play. Also in play. What I like about the potential for this upside move is that we've had a harsh winter in MACD histogram and the Four Seasons. We had a nice spring. It poked its nose briefly into summer. The winter was brief, and then spring came back in with force already. So it wouldn't take much more momentum to break out above the dragon hump, and then the swing high, and then it's up to 290 once more. Now that we've digested the new political landscape in Washington and we're able to escape the G20 summit without committing any further faux pas. On the daily, starting looking at some tactical plays here, you see some overreaction signals firing for the broad indexes of the S&P, technology, mid caps, small caps, so we'll go frame those and take a look at this. This typically happens as a like a short-term dead cat bounce, and it will have rebounded enough to attract short sellers, but they were not able to make new lows on the last one. So I'm not thinking there's going to be much power in that move unless there's some dramatic news event. But if you are trading short, I would wait to see momentum. I would start by building the position intraday, then and only then try to carry anything overnight with market's money. You see the 10-day min pain and max pain candidates. These are the symbols in their various populations that have lost the most from their 10-day highs on a percentage basis, and then these become opportunities to buy quality on sale in terms of max pain. Min pain, those are the ones that are more likely to be the relative strength leaders. Looking at the Dow Tactical 30, you see a lot of overreaction short signals firing, just a handful of dojis, 3 symbols that have fired on the auto framer, but better than 3 to 1. United Tech, Goldman, and Apple. You can see that GE and Goldman broke down below their 1 day, 10 day, 1 month, 3 month, 6 month, and 12 month lows. So broke out of those trading range and are continuing to fail. So those would become high priority short targets if the market opens weak and their sector is weaker than the market, and if they are weaker than their sector, then that's a rapid scan for a no-brainer to get short on those for tactical gains. A handful of fraud quality numbers better than 3. There's a couple, again, auto framers better than 3 to 1. So this looks more like the usual suspects. I would draw your attention to Pfizer making breakouts on a number of their look-back periods, breaking out to a new 10-day and 3-month high, for example, as did Merck. Shift into the ETF tactical, similar conditions, a handful of dojis, lots of overreaction signals, typical of dead cat bounces, but also after a double bottom, it'll be interesting to see if it can break out to a new swing high, in which case it strengthens the case for upward swings. Looking at the pinch and stretch report now, there are 4 categories of symbols based on how tightly price has been compressed, and then how narrow or wide the river is. So the first column, the most positive Z stretches. These are the symbols in the Dow and the ETF 30 that have moved the greatest relative percentage above their Bollinger Band mean. And you can see that expressed as a Z-score. So XLV at 8.5% above the middle of its river, that's a 3.5 sigma significant move above. It's rare for it to have had such a powerful move. It would not be unusual to see that have to cool off. So if you're holding those gains, you want to make sure you lock those in. But it could also become the case where it stands out so much and that capital needs a place to get employed that becomes easy to believe in. And so that's how we could see an addition of buying interest in XLV, Treasuries, Pfizer, and U.S. real estate. Conversely, the most negative Z stretches are those prices that are the furthest below their Bollinger Band mean on a percentage basis, and then you can see those highlighted in red. That's how many standard deviations below average that's achieved. So oil's 13% below its Bollinger Band mean. That's a 2.5 sigma, quite a significant shocking move in that commodity. You can see that the U.S. indexes are in pretty good shape in terms of the Z-score with price with respect to their river. So this is a case maybe the equities are starting to move back into favor. The most expanded pinch box talks about the relative width of the river compared to its historical performance. Goldman Sachs, its pinch box is 7.5% wide. That represents a 5 sigma directional move. So that's an extraordinarily wide ranging river and Bollinger Band range band, if you will. So it's hard for it to sustain that kind of directionality. So this would be one where if you're holding profits, you want to make sure you've got them locked in. And maybe consider looking at the reversion to the mean trade. Finally, the most compressed pinch box, only gold is in that condition. This is one where if you are more than one standard deviation less than the long-term average, we can say that you are exceptionally pinched. Only gold is in that position right now. And whenever it's in that kind of tight channel, then one of the ways I like to play it is with the straddle and following the breakout whichever way it goes. We would expect that to be inversely correlated with the business sectors in the S&P right now. The auto framer simply is assessing trade location and range risk with respect to the 10-day high and expresses that as a ratio. So this is a strategy for some short-term trading and opportunity trading based on simple trade location. You can see there's some a half a dozen things where the reward to risk ratio is better than 2 to 1. In the bottom half, we're looking at the RAF regression line, or the regression line fractal framework. The top shelf in the green are the symbols that are the most ATRs below their long-term fair value. So this is buying quality on deep discount. Now, you may have a hard time thinking about GE and Apple right now as quality, but nevertheless, those are things that have to be owned by hedge funds and mutual funds that are tracking large caps. And so there's an opportunity in there. If they're not going to completely go out of business, then this may be something where you have an opportunity to get some swing trades in. In the bottom shelf in the red, these are the symbols in each of those populations that are the most numbers of ATRs above their long-term fair value. So these are ones that could potentially have become, overheated. So like Procter & Gamble was 8 ATRs above its long-term fair value. So this is one that where the value play could have already run its course. That's really an exceptional performance in Procter, and so on through the rest of the list. The daily squeezes, these are candidates for one day swing trading, one day at a time, if you will. You get on this list by having a large average range, but having yesterday's price range to be relatively narrow. So if you can get a mechanical entry and all it does is move an average range, you can see the reward to risk ratio. They're highlighted in green. So in the case of Motorola, I believe that's, or no, let's look at the second one. XME, the metals and mining ETF, has a potential almost 3-to-1. If it gives you an orderly entry and a mechanical entry, it could move 3 of Friday's range and still just get to the range stat. So there's a potential in all of these. Think of these as coiled springs and one-day pops, and suitable for swing trading one day at a time. This new report here, the 4 seasons of MACD, is simply tracking where each of these symbols are inside their MACD histogram season. So you can see that Boeing is early in its spring, having just come out of the winter, and is still extended to the downside more than 3.5 standard deviations compared to its long-term average. So that's been a very harsh sell-off. You can see those symbols in the summer. These represent a lot of those relative strength leaders that we saw earlier, like Pfizer, Merck, United Health. And you can play that with either the sector spider or the individual companies, waiting to see which one continues its move early. Caterpillar being the strongest in the stack, being in the summer, and then already above its zero line in its own river. Those candidates in the fall are ones where they've just started rolling over and are failing back towards the long-term mean. And those in the winter are the ones that are suffering the most: Disney, Walmart, Goldman, Visa, Apple, and United Tech. These are all ones that I would look to be trying to get short if the market were failing and these were failing faster than it appears. Then these are potential shorting candidates here in the winter. The ADX stat is a relatively new report I'm still noodling around with. This is a measure of strength of trend, and you only get a strong ADX if you've been exceptionally directional during the swing trade time frame. So General Electric, Procter, and Verizon are all in the green, meaning they're abnormally strong readings of ADX compared to their own personal norms. Whereas those that are at the bottom of the stack, Travelers, Merck, and Disney, have been exceptionally untrending, meaning mostly sideways choppy over the past 2-3 weeks. So it wouldn't be surprised to see Travelers, Merck, and Disney become Z3P candidates here in the near future. So we'll keep an eye on those. You can see some additional indicators in the market mosaic. Basically, the 30-period regression line is flat. You see the double bottom has been in place. And now if we get a price stalling around 280, I wouldn't wait too long to cash any gains or to avoid any losses if it's going to reject the barrier there at 280. If that resistance holds true, then the next target to the downside will then come back to 265, in which case it's an even tighter channel. You can see in chart number 2, the slope of the 30-period regression line for the S&P. This is a measure of the health of the market. It's had a nice rebound off of the harsh sell-off from 2 to 3 weeks ago. That little blip and then a resumption is actually a very positive sign of potential healing in this market. Chart number 5 is taking a look at the relative slope of the 30-period regression line compared to the last 10 years. This is the slope stat. And you can see that that sell-off was second only to the financial crisis in 2008, 2009 in terms of steepness of the downward move over 30 days. So this is a market that was flirting with disaster here recently and only now is starting to recover. So check yourself before you wreck yourself in this kind of market. Charts 6 and 8 are examining the volatility. You can see how they've come back into the high range of normal after the runaway fear of a couple of weeks ago. The top chart looks at the z-scores of 3 different regression lines, the 10, the 30, and the 90. You can see that the 30 in black has healed and is already back to the midpoint of the river. See the 10 has had a series of 3 higher lows and has just come out of the river to the upside. So that's going to be seen as potentially favorable by short-term traders. In the bottom chart, you can see how price is moving with respect to the river, and you can see that very clearly the double bottom and what could be a triple top forming. So this is a market that is fragile. This is one where you want to keep your risk measured and your powder dry, and kind of stay hunkered in, survive the tension and the turmoil, and then be ready for the spring and new leadership to emerge. So keep your powder dry. And that's everything I wanted to cover for this weekend. The gang's doing a great job here at the swing workshop. We're getting ready to go through our package of, we're going to try to frame 50 trades this weekend. We'll post those in the chat room for others to review and to comment on. It'll be a good discipline for us as we go forward. So that's everything that I wanted to cover tonight. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.